All right, everyone, we are live. Welcome to another edition of Personal Wealth Strategies monthly webinar. And we have a very, very special guest flying in from Chicago area, Illinois here, Perran Wetzel, virtually speaking, obviously. And I'm very, very honored to have him on the call today. He does tax work all across the nation, setting up various entities, doing tax return, a lot of different tax work. But what I am so much impressed with Perran about is his greater and broader mission of love and charity for the world, of showing him growing up and what was possible, and now trying to take that to this generation to show them what is truly possible. And he's on a mission to go into space, do some zero gravity, suborbital space, all the way into outer space, spending 4 days in there. All along the way, raising $30 million for charity is the goal. And so his mission for this world, for the sciences, for showing what is truly possible is just so inspiring. And so I am so happy he's here to talk to us today, not about going to space, but on his regular day job of taxes. So we have filed taxes already, hopefully, for the prior year. And even if you haven't, there's really not much control you have over what happened last year. However, we just hit the halfway mark in 2023. And so there are potential planning strategies that you can implement this year so that you can help to save on your tax bill for next year. And Perran is definitely the guy to talk to you about doing that. So we can't get into all of the different things that you could potentially do, obviously for unique situations, but he's just going to give some broad general ideas of how he thinks about taxes, tax planning, and how you can pay your fair share or not. So Perran, with that, take it away.
Okay. Thank you, Justin. I really appreciate, you inviting me on your show, and would like to also thank your colleague, David, for also having me here. I really appreciate what you have, done. I enjoy having conversation with you, and would like to provide you and your individual with some value. So I'm sharing my screen. Is that okay with you, Justin?
Yeah, that's perfect. You could even make it bigger too, and go into presentation mode. There you go.
Yeah, let's go into presentation mode. How is that?
Perfect.
Okay. So as Justin said, how to pay your fair share in taxes or not, and what does that mean? So we're going to go into a little depth about that. Before we get started, I want to give you a little background of who I am and what I've been doing. My name is Perran Wetzel. They call me the friendly accountant. I have been doing this for 44 years. That's right, 44 years doing taxes. And when I first started doing taxes, they didn't have computers. All right, when I talk about computers, I'm talking about, the PC. Back in the day, they didn't have PCs. They were doing everything by hand. One of the first things that happened is that I did get a PC. Matter of fact, I paid $12,000 for my first PC in the early 80s. And we didn't have any tax software. We didn't have anything. So my first year, I created a program so I can do taxes because I didn't like to write. And I've been doing, progressively moving forward every year as we relate to taxes. I'm also registered with Internal Revenue Service. And matter of fact, I've been tracking them for the last 44 years. You might want to ask, why am I tracking the Internal Revenue Service? Because every country or place wants to have a strong tax basis, because in order for you to continue to grow your country and be successful like we are in the United States, you want to have a strong agency to collect your taxes. But we also only want you to pay your fair share. And everybody is different in what they believe their fair share is. So that's why I come in, helping individuals understand about taxes. Do they want to pay less taxes or do they want to pay more taxes? You can determine that by how you construct your economy, because everyone has their own economy. And each economy is different that you have. So I've also, written some books. I speak nationally. And I always, like I said, have been tracking the IRS for 44 years to making sure that I keep up with the technology, things that they look for, how to make sure that my clients haven't been audited. And a fun fact about me, is that I've been audited twice by the Internal Revenue Service, and both times I received a bigger refund back. So you can get bigger refund back if you're audited, if you know what you're doing. So let's continue to move forward here. And the foundation that we want to look at is what you focus on. And what you focus on is going to tell you how your business and how things are going to grow for you. For instance, there are two types of individuals that we consider. We call them low financial efficiency individuals and high financial efficiency individuals. And typically, anywhere between 95 and 80% of all individuals are low financial efficiency individuals. And we're going to go into a little bit of detail about that. And it's okay, because we need everyone in different situations in order to have an economy. Because if nobody wanted to become a carpenter or nobody wanted to become an electrician, then how would those things get done? Because everybody has something that they love to do. Now, let's get a little bit more in depth about this. So low financial efficiency individuals, they accumulate a lot of debt. What else do? They pay more taxes. They have liabilities. And liabilities are good type of liabilities and they're bad type of liabilities. And what's the difference? A good liability would be where that you create a debt and that debt is used to generate income. If it's generating income, that's a good liability. But you accumulate debt and it's all about consumer-oriented things. What happens is that you can never grow. Your debt that is based upon you consuming things is not necessarily a good thing. But that's okay if that's what you want to do. But if you want to grow and be successful, you want to go beyond that. And they have a fixed determined income. What's a fixed determined income? That means typically a person has a job. I think 95% of individuals in the country have a job of some sort. And then we're going to go into the difference between fixed and unfixed income. Whereas at high efficiency individuals have all types of different streams of income. As I mentioned earlier to Justin, I have one business that has 11 streams of income. And based upon that income, I can determine which one of those streams of income I want to spend more time on to develop. And you need to be able to develop those things. Focus. And assets. An asset is something that generates income for you. An asset, for instance, a lot of people say that your house is an asset to you. It could be and it could not be, depending on the situation. But a rental property is an asset that's generating income. Stocks generate income, a dividend, or you can sell that asset. Write-offs. Write-offs are some of the biggest things that different between low financial efficiency individuals and high financial efficiency individuals. And we'll go into write-offs with more detail as we move along. And debt acceleration. What does that mean? Being able to pay off debt in a much more efficient and optimal way. So these are the things that we look at when you differ between a high financial efficiency individual and a low financial efficiency individual. And what does that mean and how does that relate to taxes? It's very important how it relates to taxes because we have a tax matrix. All right. And this is where everything flows in the tax matrix. So the number one thing between a low financial efficiency individual and a high financial efficiency individual is that they have 100% of the cash flow coming in their Social Security number. That's right, your Social Security number. And what type of income is that? The least optimum type of income that you can have is a W-2 job. And we're going to explain that. And that's okay if you have a job, because most people need to have a job, even if they decide to go into business or something, in order to pay their bills or to at least get started because they don't have any experience. So there's nothing wrong with having a job. There's nothing wrong with starting off that way, but do you want to remain that way in your life? And why is it most unoptimal way in which to do it? Because of this fact. Yes, 33% of all your income disappears before you have a chance to touch it. That's right, touch it. And me, myself, one of the major reasons why I've never had a job in my entire life, because I didn't want anyone, first of all, telling me what to do. And second of all, somebody taking 33% of my income before I ever get a chance to touch it. And what I mean by that, if you have a job, look at your W-2 form, I mean, not your W-2 form, but your check stub, it says gross. Then it says federal income taxes, Social Security, Medicare. And then if you live in the state, that state income taxes, state income taxes. Then if you have retirement, health insurance, all these things come out of your money. And then they have what they call a net. And typically just with the taxes alone, that's 33%. That means that 33% of your money you have no control over. That's one thing. The second thing is that the average individual, after they receive that 67%, they go out and spend their money, right? They have to buy clothes, food, car, mortgage. They pay all these different expenses. And they're just expenses that you have. All right. So right now, we take 33 and 50, that's already 83% of all your money. And then we throw another thing in there, because the life tax. What's the life tax? When you spend your money, you pay taxes too. Think about that. When you go to the grocery store, when you buy clothes, you buy a car. So that means that they tax your money before you get it, and they tax your money when you spend it. Wow. I don't know what to say about that. That's, hey, if I had that plan, that's the best plan in the world. Well, I need to become a government. No, that's joking. All right. So we had 97%. So you get 7% of your money. Okay, 7% of your money afterwards. And that's all you have is 7%. And inflation is running 4%, so you have basically 3%. You know, you could, if this is your plan to become wealthy, 99% of the time you're not going to get wealthy. A few people, on a job that make, $1 million on a W-2 form or whatever that number is, but not a lot of people. Okay, and then for somebody to take 33% right off the bat, that means that you make $1 million, they take $300,000 right off the bat. Okay, so let's move forward. And what's the difference between a high financial efficiency individual? And that's where I've always liked to stay. A high financial efficiency individual has 100% of his income coming in the form of an EIN number. And not just any EIN number. You want to have it to come into an entity, because some people create an EIN number for a sole proprietor. And I would never recommend anybody to stay in a sole proprietor except for very limited reasons. And that's, a different subject. So you want to have an S corporation. Typically, we have some type of entity. S corporation is a foundation of being able to start creating wealth, as well as be able to control how much you pay in taxes. Because some people want to pay taxes. Why would you want to pay taxes? If you want to qualify for traditional financing, all right, what do you need to have? You need to have income, because they look at your debt to income ratio. And the more income you have, the more mortgages you qualify for. And the more, of course, taxes you pay. But taxes aren't equal all across the board, because you pay taxes on different types of income in different ways at different rates. So one of the things you need to know is that there are different types of income, and based upon the type of income you have, determine what type of tax you pay on that income. That's another subject in more detail. But this is what we talk about. When you have 100% of your income come in the form of an EIN number, what happens? What happens is that you pay zero in withholding taxes, right? The government doesn't get a chance to touch your money first. You get to touch 100% of your income. And if you can touch 100% of your income, that means that you can create wealth. As opposed to giving your money to the government, you can use that money to make money and then determine what you want to do with the government. Because another thing that happens is that when you have an entity, you get to use 50% of the money. I mean, use, that means that if I make money, I can take my expenses against the income that I make, and I determine what my profit is, and that's where I determine how much the government gets paid. Whereas that you on a job, they tax your what? Your gross income. And what the difference? And the difference is my cell phone. My business pays my cell phone bill. But if I had a job, I cannot deduct my cell phone bill or my telephone. All right. If I have a car, I can deduct my car expense against my income. If you have a job, you can't do anything with your car. It's a complete liability. If I pay rent, I can deduct rent. When I travel, I take business trips all the time and travel because if I can control my expenses as it relates to travel and the business expenses, I can write those off. If you take a vacation, you can't write that off your taxes. But would you rather pay taxes on your gross income or your net income? It's your choice. Which one is more efficient for you to be able to do this? We still have to pay that life tax. In Illinois, we got a break from it for a minute there. We were able to reduce that down to zero for about a year, but I still have to pay that 10%. So instead of paying 43% before I get a check for my money, I get to only pay 10%. But I still have control over that. So now, that means that we pay our net taxes on 40%, and we get to deduct those deductions off of that amount of money. So effectively, I can reduce my tax rate down to 10%. And then I have 30% to do some investing on. Now, it may be beneficial for you not to do this. And as I mentioned before, but you could just choose. The government doesn't choose. When you have a job and the only thing you have a job, the government chooses how much tax they get to take and you get to pay. Whether you have a business or entity structure, you get to decide. And taxes are made for you as an individual to use those tax laws to the best of your ability. People talk about Trump all the time, but he used the taxes law to his advantage. And you look at most of all the individuals who are in politics, there are two common denominators, basically, that attaches all politicians to each other. One, 99%, well, I'm not going to go with the average, 75% of them have a business of some sort, and then they all own real estate. And if you look at the tax laws are made to benefit individuals who have real estate, who own a business. And they're always going to be like that. Individuals who the only thing that they have is a job, and that's the only source of income, are always going to be the individuals who are going to pay the most in taxes. And the people here, the reason they're here is to be able to find out what's the best strategy for them. The best strategy, like I say, I have people that want to pay taxes. I also have people who don't want to pay taxes. I have people all in between. And depending on where you are, what your strategy is, determine how you're going to pay your fair share. And paying your fair share of taxes may not be the optimal financial decision, or it may be. So this isn't to tell you what you should do. If you're going to be working with any individual who's doing your taxes, you need to make sure that you're having conversation with individuals before time, because as Justin mentioned earlier, when you are planning your taxes, you need to start January 1st, because by the time December 31st gets here, there's no planning to do. So you need to have a game plan. If the car is, do I want to reduce my taxes? Do I want to have mortgages? What it is that your goal is for the next 2 years? If your tax preparer is not doing that for you in regards to, giving you advice or having questions, or do you just give him your taxes and then he gives you an answer back, you maybe need to look at a different preparer. Because what we do in my office, we had conversations with individuals, that some people don't even know what's tax deductible and what's not. And that's important, especially when it comes to business. Typically, 99% of everything that an individual is looking for do not know what's tax deductible. So we help them with that. So you see the current graph. This is what the average consumer situation looks like. They spend 33% of their income on taxes, 33% on interest, and 33% on living, which means that they have a choice on only 33% of what they're doing. And what we want to move out to, if we want to move to paying 10% taxes, 10% in interest, and 80% in living. This is a better way in which you are able to do the things that you want to do in life. And in life, you're either going forward or you're going backwards. And in business, it's the same thing. Your business is going forward or going backwards. And I've had individuals who have, they wanted to save as much as possible on taxes. And as long as your business is intent to generate income, almost anything is tax deductible. Few things that aren't. For instance, political contribution. Political contributions aren't tax deductible. But businesses still pay political contributions because it's in pursuit for that business to generate profits or income. So people don't realize that even though it's not tax deductible, you can also pay for an expense out of the business accounts, even though it's not tax deductible. So it's different because you're pursuing income. Like I said, I had a client, they were in the pursuit of generating income and they never made any profits, even though they were in the pursuit of doing that. And that pursuit lasted from 1984 until 2022. They were in the pursuit to make income, profits, but they never made any, which says that they lost money since 1984 up until 2022, even though they were in pursuit to make money. All right. Now, one thing that I do want to mention in regards to the Internal Revenue Service, I know a lot of people heard that the Internal Revenue Service, were hiring 80,000 new people, right? And everybody got, wow, the Internal Revenue Service is hiring 80,000 new people. Now they're going to be auditing people. They're going to be doing all these different things. You look at the fine print, 55,000 people are retiring. So if you take 55,000, you take 80,000 minus 55,000, what is that, 25,000 people that they're adding? And it's going to take them 3 to 5 years to even train all those individuals. First of all, it's going to take them a long time to hire those individuals. So that's down the road, 5, 6, 7, 10 years down the road. So, I don't want to make sure people aren't getting afraid of the Internal Revenue Service. I love the Internal Revenue Service, to tell you the truth, because they are the entity that's going to help us remain a strong country. People don't realize that. And I'm for the Internal Revenue Service, I'm for the government, but at the same time, I want to make sure you pay your fair share, whatever you believe it is. And the IRS is not auditing people. What they're doing is that what the IRS is doing is they're making sure that they have all this information on you. Like, for instance, any type of financial transaction, they have a record of it. 1099, 1098, W-2 form, all these different forms, and the IRS is receiving all this information. When they receive this information, they can match that information against your tax return to make sure that you're properly reporting all your income. The area that you have the most leeway with is your expenses, because they don't know what your expenses are. They can know what your income is, but your expenses are where you have the most control over, where you can control how much you pay in taxes. And all income is not the same. But people think that income is income. No, it's taxed differently. Like short-term capital gain. Short-term capital gains are one of the highest tax income there is. A 35% tax right off the bat. 35%. Short-term capital gains are considered any income that you make within a short period of time, which is a year or less. Long-term capital gains by far is a better way to get taxed because you pay anywhere between 0 and I think right now the new capital gains rate is 25%. So you want to make sure that you're, capital gain. Also, short-term and long-term capital gain losses, you can only deduct $3,000. $3,000, even if you lose 100,000, you'll be spreading out $100,000 loss over 33 years and you don't make any money. That's another area. Rental income and rental losses. Rental losses. If you are active real estate investor, the max that you can write off is $25,000 in losses. Because typically a real estate transaction, you have passive income, generate a positive cash flow, and for tax purposes, roughly about a $6,000 loss. And cash flow is the key when it relates to passive income in regard to real estate. You want to have positive cash flow, but for tax purposes, it generates a loss of an average of $6,000. And people want to realize, well, how does that work? Well, that's why you want to have a professional and start talking to a professional to show you how to have those losses on your real estate. And if you are a real estate investor active, your W-2 income needs to be controlled, because if you make more than $150,000 in W-2 income, what happens? You cannot deduct those passive losses. They move forward. The only other way in which you can do that is to take those losses and make them unlimited if you are a professional real estate investor. And there's two requirements to become a professional real estate investor. You must spend 50% of your time in regard to real estate and a minimum of 750 hours. And this is what people don't qualify. If you have any type of job whatsoever on a W-2, you're almost impossible to qualify for a professional real estate investor. The only way you can qualify is you're involved in some type of real estate business. For instance, if you have an S corporation is involved in real estate, then you can do that. But there's always type of strategies. If you're on a typical job where you're working for a tech company or a Fortune 500 company, more than likely you won't be able to do it. Doctors have problems with that. What they have doctors do, they marry somebody and their wife becomes a professional real estate investor. A great tax write-off by marrying a doctor, the doctors, the lawyers that are in a high income bracket, marry somebody and make them a professional real estate investor. And then you can save hundreds of thousands of dollars of taxes. So that's one of the strategies that we also recommend in regards to doctors and lawyers and people who have high income on W-2, how to become professional real estate investors. Get married. Perfect tax strategy. But the best tax strategy of all, though, is when you die. When you die, the perfect tax strategy. Okay. Where that you can pass on all these great things. For instance, real estate. You have investment property. When you pass away, the real estate goes up to the stepped up value. Example, if you bought a house of investment property for $100,000 and you die 30 years later, for your purposes, the book value would be zero. But for the person who inherited the property, it would be what it is at the time that you pass away. Say for $200,000, that means that their stepped up value is $200,000, and they can depreciate that property for another 27 and a half years on that $200,000. But now you got a $300,000 tax deduction on a property that you only spent $100,000 on. But it's more complicated than that. That's just this example about how that goes. So I don't know how much time did I have, Justin. I don't know how much time I had, so I can continue to go with some more tax strategies.
You were doing great. You're we're ready to wrap it up. If you are, you've got something that you really wanted to share, you can do it. But we were scheduled for a half hour, and you pretty much hit it right on the head. So anything else you'd like to share that would be impactful?
Okay. Yes. Whoever listens to this, when you have a tax professional, anybody, anything you want to do, always make sure that you have a professional. Because anything in life you can do on your own, but you want to have it done right, have a professional. Justin is a professional. Dave is a professional. They can provide you with your gift. And don't listen to your brother, your cousin, or whoever. That people have a tendency, oh, this person told me this person told me that. And then they want to do a tax strategy, it doesn't work. Because every person's taxes are geared to what they are doing, what their risk tolerance is. Everyone is different. So nobody can plan you a tax strategy made for anybody. You need to have a consultation with an individual. That individual is a person that's going to give you advice that you trust and get to know the person. So if the person only does your taxes, they don't have any consultation, you need to have another professional with you.
All right. Thank you so much, Perran, for that. And he's got his contact information right here on the screen. So I encourage you, if you have further questions, definitely reach out to Perran and get those personalized answers. We do have this webinar every month. And so I'm going to turn it over to David to preview some webinars that are upcoming. So David, what do we've got coming up next?
Well, coming up next, just so happens to be on August 2nd at noon, we're going to be talking about Social Security Decoded, essential insights for optimizing retirement benefits. So today we optimized our tax strategies. Next month, we're going to optimize our retirement benefits. We have a very special guest speaker. Justin Rice will be presenting on Social Security Decoded. So that's going to be an interesting, probably one of the areas of planning that we get the most questions. One of the areas that people make the biggest mistakes is on Social Security claiming strategy. So it's going to be an important webinar to attend if we can get you off the beach on August 2nd during the summer. The following month, September 6th at noon, we're going to have another area that comes up a lot in retirement planning that we get questions, and that's navigating Medicare, essential insights for approaching age 65. And our guest speaker is going to be Mark Brownstein, who's going to talk about navigating the Medicare landscape, which continues to be an area I have lots of questions on that don't always seem to get answered. One of the things of dealing with big government. So those are our next two webinars, and it all looks good. Yes, Perran. Perran's raising his hand.
Oh no, I was telling my office. Somebody was coming.
Oh, okay. I thought you had a question. All right, Justin. That is our upcoming our next two webinars, and we're excited to present both.
Awesome. Thank you for that, David. Again, thank you, Perran, for taking time out of your space journey to come share with us here on Earth how we can best help this United States of America as we hit her 247th birthday yesterday. So thank you so much, Perran. Any final from you?
Thank you, Justin, for having me on your show. I really appreciate that. And if anything that I can do for you in the future, just let me know. I'll make myself available. Thank you all.
All right, we'll see you, Perran.